Hello everyone, Tony here. US stock markets ended last week on a high note as the US and China agreed to significantly roll back tariffs for 90 days, while cooler CPI and PPI data strengthened expectations for Fed rate cuts towards the end of this year. Late on Friday, ratings agency Moody's downgraded the US credit rating from AAA to AA1, citing mounting government debt levels. This action follows previous downgrades by Standard & Poor's back in 2011 and Fitch, who downgraded the US credit rating in August 2023. The downgrade has already impacted markets this morning, with S&P futures dropping by about 0.75%, while NASDAQ futures are trading over 1% lower. Meanwhile, yields on US Treasury notes at the middle to long end are climbing. We're seeing the 10-year yield trading towards 4.49%, while the 30-year yield is trading close to that 5% year-to-date high, which did trigger some warning signs last month. Now, looking ahead, President Trump plans to announce new tariff rates for US trading partners in the next few weeks. And meanwhile, the US and Chinese finance ministers are scheduled to meet this week to continue trade discussions, which appear to have stalled. Earnings reports from Target, Home Depot, and Lowe's will also be in focus after Walmart's warning last week about potential price hikes due to higher tariffs. Let's take a look at the charts of the S&P 500 and the NASDAQ to see how they look as we start this new week. Okay, so starting with the NASDAQ. Now, this time last week, the NASDAQ was still trading below this 200-day moving average. A few hours later, of course, the announcement about the wind back in US-China trade tariffs. And that prompted a very aggressive gap higher. So what we like is that it has cleared up the congestion around this 200-day moving average, which we'd seen over the past week and a half. And it now appears like we're seeing a wave 3 higher in the Elliott wave framework. This has been a correction, a 3-wave correction, your wave A, B, and C. We're now in wave 1, wave 2, wave 3 has been completed probably, and most likely we're seeing the beginning of a wave 4 pullback back towards this 20,500 area. Now, providing it holds above this 200-day moving average, which sits around 20,250-ish, and providing it goes no lower than this support area over here, 19,250 to 19,150, I suspect that we're going to see buyers come out here and we'll see another push higher towards record highs. If we were to see a break of this support area here, then you would have to start looking at this as being just a vicious short squeeze, and we're going to retest the lows. Absolutely possible, but we need to have our safeguards in place to prevent against being caught on the wrong foot in the eventuality that this does reverse lower. For the S&P 500, a similar story. It gapped higher last Monday, and what you can see now is very impulsive characteristics in this rally from the April low around 51.01. So we think this is most likely a wave 3. We're looking for a wave 4 pullback into this 200-day moving average, which is coming in around 57.60 to 57.50, possibly a fraction lower. It wouldn't surprise me given the volatility in these markets. But then we expect to see another leg higher for wave 5. Now, as I mentioned with the NASDAQ, we do need safeguards in place. And if the S&P 500 were to see a pullback which took it below this 200-day moving average and then took it below support around 5,500 to 5,480, we would again have to change our view that this has been a correction. We would change it to the idea that this has been a short squeeze and that we're going to see another leg lower. So at this point of time, we have to play the probabilities. We have to use those guardrails. And this is how things stand as we start the new week. Thank you for listening.